Yep, sterling yen took a nice drop last few days. Wow, a couple questions right off the bat. Jaguar Leon says, hi Chris, you still spend your time with guys with strange names? I don't understand that question. You still spend your time with guys with strange names. I have no idea what that means. You have to help me out there. Yeah, I have no idea what that means. You'll have to elaborate a little bit. Michael says, can we look at some daily charts, please, sometime, Chris? Yeah, we're going to look at some, we're actually looking at, I'll pull up a daily right now. We'll begin, the first trade we'll look at will be on a daily chart of gold. We'll be talking about that. The webinar will be recorded today. Yes, it will. So that's what we'll be looking at. It will be recorded, so you can come back to this again and again and again, and which is good. I actually have a really good lesson today that I want to talk about. By the way, how's Cam? Oh, we only have 45 minutes because Boris is after me. Oh, my. Okay, fair enough. All right, Cam's good. All right, well, then let's go ahead and just get into this here. So first off, I just want to start with a brief story, and this is a really good story. I tried to think of a name for the story itself, and I thought of a very charming name. It's a story about death. And not the kind of death you're thinking of, but we'll talk about that very specifically, a different kind of death. So, and it's a good story because it really, a lot of times I share a lot of success in terms of, profitable trades, but I want to share about, a big mistake I made once. And we'll talk about that, and then we're going to get into analyzing some trades. So I have an algorithm that I use to trade the markets. It's one of the things I use to trade the markets, but it's an algorithm. And the reason why I like to run the algorithm is because while I'm asleep, that's when the algorithm really needs to be running. And so it's usually designed to capture around the market open, the London session open. And my philosophy with trading algorithms, and somebody had asked this, one of my students had asked this, my philosophy on trading algorithms is the same philosophy I take with our fund, which is white box trading. So the algorithm can produce signals and alert me to the signals, but I want to be making sure the algorithm is running correctly, confirm it, and then enter the trade according to the rules of the algorithm just to make sure everything's functioning properly. Because there are going to be times where technology just doesn't work. It just, for some reason, it just doesn't work. And things can happen, and that's why I always like to have a human element in there. On top of it, algorithmic trading as a whole, if you think about it, algorithmic trading is based on an algorithm that's designed to recognize a pattern in the market. And there are going to be situations in the market that no algorithm can ever compute or calculate or understand or digest. And that's when the algorithms are going to go bad. They tend to go bad. It could be an internal technology problem, maybe the algorithm communicating with the platform, or the platform and the algorithm not functioning together, or something like that. But the bottom line is that I generally prefer a white box approach to it. So I can use the algorithm to do some of the work for me, have the technology do the work for me, spot the setup so I don't have to calculate all the numbers or, the entries or anything like that, and then check to make sure everything's running correctly, and then boom, and then I'm in. Well, the other night, it was, I believe, last week. It was, I want to say Friday last week. So I was running the algorithm that I normally run, and when I run it, I have somebody who watches it. They check it to make sure it's running correctly. But they had to go out of town for the weekend, and they had to leave Friday morning for a flight, so they couldn't watch it. The normal person that I have watch my personal account, not the trading fund. The trading fund, we always have a team watching. But for the personal account, when I run the algorithm, I have a specific person watch it to make sure the algorithm's running correctly and doesn't go off the reservation. Well, that person couldn't run it. They couldn't watch it. And I had said to myself, well, we've had no problems with the algorithm. The algorithm's executed everything the way it was supposed to. And you know what? I'm going to run it because I think it could be a profitable day for the algorithm. Everything's looking like it's going to set up right for the algorithm to win. And so I decide to run it without anybody watching it. And go figure, the day that I do that is the day that the algorithm has a problem communicating with the platform for a couple specific reasons that I had to parse out with my programmer. Well, let me tell you how it all ended up. It executed 5 trades, which is, it normally executes between 3 and 5 trades in the London session, sometimes 2, but 3 and 5 trades. And it executed the 5 trades. It won 3 out of 5, so the algorithm worked out great. But here's the problem. The algorithm kept entering in trades. And it wasn't just entering in trades. When it re-entered a trade, it doubled the position sizing, and then it did it again and tripled it, until eventually the position sizing got to 6 times. And that became a problem for a couple reasons. One, the original algorithm was correct in spotting the move, but then the move was done. It wasn't supposed to be entering any new trades. Now the market started going in the opposite direction, and it kept hitting the button, executing trades. On top of it, the communication problem between the broker platform and the algorithm was causing it to misplace stops. So instead of placing a 20 or 30 pip stop, it was putting it like 200 pips away. And lo and behold, the market was going for a run against the second, third, fourth, and fifth versions of the algorithm. So as it kept pumping out trades, it was just piling on a position that was going negative. Well, I woke up in the morning, and I turned on my iPad just to see what was going on because I have my iPad with me, and I noticed something very bad was wrong. And I was kind of confused because it was in a load of positions it shouldn't have been. And it's never in positions by the time I wake up. And then I just noticed that some of the positions were heavily negative. So I immediately woke up, went downstairs, closed all the positions, and when I had assessed the damage, guess how much my account had lost from the algorithm? Rough guess. Any guesses? Keep in mind, double, triple, quadruple positions across 3, 4, 5 pairs. Gabriel says 30, 10, 50, $1. Really, Boyke? Really? I'm going to say percentage. So in terms of percentage, no margin call. No, I had plenty. It lost 39% in one night. And keep in mind, that erased all of my gains for the year. All of it and then some. I was only up about, I want to say I was up about 18, maybe 19% for the year. You know, I haven't been too active in trading. I've only been trading part-time, you know, because I'm writing the book. And so I can't trade as much right now. If I trade, then I don't have time to write the book. And it took out 4 months of gains and then put me in the negative. Now, here's the next question. Guess how long it took me to just get over it? Any guesses? Now, imagine, I would like to say, before you do this, imagine if one morning you wake up and you've been running your algorithm for 6 months and you've had no problems. On the one day that you don't let somebody watch it, it goes wild and wipes out 4 months of gains and then puts you in the negative. It took me about 30 seconds to get over it. And here's why. Which is that, first off, you have to be able to deal with losses. You have to be able to let things die. And that's why this questionnaire, this beginning session, I want to talk about is about death. You have to let things die in the currency markets. You cannot be stuck in the past. You cannot be stuck in a trade that, already is gone. There's nothing you can do about it. And so as soon as I controlled the damage and closed all the positions out, my first thought was, is there anything I can do about it? No, there's nothing I can do about it. And then I said, well, I can make sure that this doesn't happen again. I can do that. But is there anything I can do about the losses anymore? Is there anything I can do about the fact that the algorithm just went wild and took out 4 months of gains? Nothing. There's nothing I can do about it. Is it going to break my bank? Is it going to kill me? No. Is it the end of my career? No, I've been doing this for 10 years. Can I still end the year profitable? Certainly I could. Certainly I could end the year profitable. It's certainly possible. I'm still going to gun for a 20 or 30% gain for the year. But the bottom line is there's nothing I can do about it, and you have to let things like this die. You have to just let them die, be done with it, not thinking about it, because if you're constantly stuck on this one loss or this one trade, it could cause you to be fearful to make the next trade. If you're stuck in the past, you will never be here fully in the present to relate to it with what it is. And, ironically, I was also reading a book about the samurai and how they used to meditate on death all the time. The whole point of why they would always meditate on death was because if they got over the fact that they were going to die, they're probably going to die some horrible death, and they just weren't that fazed by it, then they could put 110% of their being into that moment. They could be totally present. They could just unleash everything inside them in that moment, in every moment, whether it was on the battlefield or it was sipping tea. They were always 110% available to the moment because there was no part of them that was afraid of death, and there was no part of them that was afraid of anything in the past. And so because of that, they could fully enter the present and unleash their full intelligence in the moment. And I really appreciate that kind of philosophy, which is, the bottom line is there's nothing I can do about this at all except make sure it doesn't happen in the future. The money's gone. It's not going to break my bank. I can always make more money. I can't make more time, but I can always make more money. I can always make this money back. I have the fund. I can always put more money in the trading account if I need to. There's a lot of things I can do to it. But the bottom line is it's not going to break my bank, and it doesn't mean anything to me now. It's gone. That's it. So with that being said, you have to just be able to let it go and then start making trades again and get back on the horse. You have to get back on the horse and be done with it and move on. Just let it die and move on. I can't tell you how many times earlier in my career that if I had a big loss, I would be paralyzed to make the next trade. This was very early on in my career. In fact, I think I talked about it where I had I had lost $50,000 or $60,000 in like less than 15 minutes, and I was paralyzed after that. And it was very early on in my career because I didn't have a track record of doing this for years and years and years, and realized, hey, you know what? Maybe I only make a little bit of money trading this year on my personal account. So what? Not the end of the world. I still have my fund, which is a larger portion of my income. I still have money in the bank. I still have investments. I'll be fine. I'm not looking at this as a one-time thing that defines my entire trading career. I'll make all the money back, and then I'll keep going, and I'll keep trotting along the path. And so, with that being said, it's important, no matter what kind of loss you encounter, to not make it anything about you, that a loss is not a defeat, that a loss is just a loss. You learn from it, you move on, and you don't get stuck on it, because it's not going to do you any good. How many of you have been paralyzed to make a new trade because of a recent loss you had, or a loss you had a while back, and then you just couldn't make the next trade? Your system was telling you, all systems go, it's a trigger, get in, you got a good price, time to enter the market, got a great setup, and you forgot to make the trade, or you didn't make the trade because you were paralyzed, because you were frozen, because you couldn't decide, well, I just lost, maybe this won't be right, or this and this and that, blah, blah, blah. And has it ever happened to you guys? Yes, no? Jaguar, Harley, Jim, DJ, Bernard, Rob, Jesslyn, Gabriel, May, Fernando, FXR, Jen, Ganser. Good. And you know what? BFD. Eventually, you'll be able to get over those losses when you start to have a longer career, because you realize, wow, those losses back in the day were just losses, and I've passed that now. I've gotten past that because I kept moving forward, and I was able to make up all that up and keep going. And now my account's building, and I keep, tracking new profits out of the market. Eventually, you'll be able to pass those things up, and you won't be thinking about them anymore. They won't paralyze you anymore. So hopefully you find that story useful. Hopefully, you find it of value. But, imagine losing, this is your personal account. So, keep in mind, imagine the situation, you have a fund, you have investments, you have money, you own gold and silver, you have a house, you have all these things. But imagine your normal trading income from your personal account just took that kind of hit. How would you respond? Would you make it something about you? Hopefully in the future, you won't. And so it's more common for newer traders to do it, but it's more common for newer traders to do it, but as you gain experience over time, you'll no longer let one trade or one giant loss define you. So hopefully you found that of value. Okay, so let's get into some brief questions, and then I want to get straight into gold, and then maybe we can look at Al's sterling yen on the 1 hour. So Tri Desert says, are you a pedestrian now? I'm not really sure I understand that question. I have no idea what that means, so you have to re-explain. I don't understand what that's in relationship to. Gabriel said, what was the largest drawdown you've ever had? Well, when I first started trading, so I took 3K and turned it into 83K in 6 months. And then in about 12, 15 minutes, I lost about 50 to 60K. So that would have been my largest drawdown ever. But, the algorithm going wild, it didn't exactly make me excited. But it was definitely up there. So, yeah. So hopefully answers your question. Rob, since I've been paralyzed and also missed a lot of trades, so I'm making sure I looked away from the screen when I should. Yeah, and that's the whole thing of why the samurai would always meditate on death, because eventually if they just got over the big one, that they're going to die, that they're not going to be able to, that they will cease to exist, if you just get over that, then they could always, once they got over the fear of death, they could just bring everything to the battlefield. They could bring everything to their life. And maybe that has to happen in trading. Maybe you have to have some devastating thing happen, and then you just get back up anyways, and you say, I'm going to keep going forward. I'm going to rebuild. And it's in that moment that you'll forge a new trading career. You'll no longer be paralyzed by those things or miss trades anymore. I didn't miss any trades after that. As soon as that happened, I said, okay, we're going to correct the problem, talk with my programmer to confirm everything like that. And then at that point, I said, okay, I'm, going to start trading again. And by Monday, I was making trades again. So that was it. So get confidence back with a smaller trade scalp. No, I'm not going to adjust my strategy. I do think it can be useful to try and build up smaller wins because the win itself will be a confidence builder. But you don't want to go off the reservation on your strategy or anything like that, because then that will just bring in behaviors and get you in the wrong mindset. So eventually you could end up just switching totally scalping, even though you've never fully researched it or really perfected it. So that's my thoughts on that. Yes, Al, we'll get into sterling yen after we finish the gold. Last few questions, and then I want to get into this. Gabriel says, Chris, do you plan on employing a different strategy now in order to get the money back and make 20 to 30% on the year? No. And here's why. Because what I was doing was working. There was nothing wrong with the strategies. There was nothing wrong with the strategies. It was just a question of technology not working. So that's all. That's all it was. So why would I adjust anything different? Why would I do anything different? What I was doing was working. It was just a brief moment of technology not working. That's all. So hopefully that answers your question. New quarter. MI says, so for a newcomer, do we just keep stops tight to hopefully avoid big losses? You keep stops. The size of the stop is not going to determine your risk. Your position sizing will determine your risk. I could have a 5-pip stop cause more damage to an account than a 50-pip stop. How? Through position sizing. So I don't think necessarily tighter or looser stops is the way to do it. The way to do it is to make sure you have fixed position sizing in the sense of you're always risking 1%, 2%, whatever it is. So hopefully it answers your question. Let's see here. Just paralyzed with the idea that I need to wait for a few days and then start your Forex courses. Well, Jaguar, whenever you're ready to come, then you can join. Whenever you're ready, you're ready. So hopefully, whenever it is, you'll be ready and we can start the learning process there. All right, last few and then I'm switching to gold. Michael says, did you analyze the market before closing or just close out regardless? Well, I took a brief look at it, and so, I looked at it, and the market was just, it wasn't even close. You got to remember, the trades that normally had 20 or 30 pip stops, where the algorithm was producing 200 pip stops, and the market was just way negative at that point, and just taking longer and longer and deeper losses. So, no, it was just a brief look. Hey, does this even have any potential to come back? It's way negative. Why even bother? So, I was way over leveraged at that point. I didn't want to be in those positions. I wasn't supposed to be in those positions, so I just got out. There's no point sitting there going, oh, well, maybe I can get it back. No, that's ridiculous. That's just praying. That's hoping for something to work out when you never want to enter a market. Anytime you enter a market with the system, you're doing so because of a fixed reason. If you're in the market for the reason that you're not supposed to be in the market, then the bottom line is, why would you be in that trade? So hopefully answers your question. Michael says, was holding on to some positions an option. No, it wasn't. It wasn't an option. So it wasn't at all. Okay. So with that, Jack says, big news can make massive price actions. This type of price action is killer in FX. But even most FX guru talk of price actions, they fail to address this price action today. See Euro USA. I'm not sure who you're talking about there, Jack. You talk about all these other FX gurus. I'm not sure who you're talking about. It's kind of an ambiguous statement to say big news can make massive price actions. This type of price actions is a killer in FX. But even most FX gurus talk of price actions, they fail to address this type of price. I have no idea who you're talking about. And even if you're talking about other people, how can I comment on their style of trading? I don't know their style of trading. I don't know their strategies, so it's pointless for me to comment on that. So I really don't find that a useful comment. I'm not really sure where that comes from. It feels like it's coming from left field. Okay, Phil says, just so I understand, is the algorithm a robot EA? Yes, it's an expert advisor, but normally I have somebody monitor it. In this case, it wasn't. All right, let's get into this trade here on gold. And so I talked about last week, particularly I think it was in the premium webinar for gold, and here was the main thing I talked about in gold. I think it was the premium webinar. It could have been the monthly webinar that was open to members. So gold, after getting slammed by 1790, has had a very clear relationship to the 20 EMA. Other than this one rejection, the pattern's been very much the same. So it would close above it and then close right back down. Break above it and close right back down the next candle. Break above it and close right back down the next candle. But notice the section of price action from, say, here to here. Do you see how the bars are relatively decent size? They're of good health. They're, it shows there's volatility, there's participation. Even though the buyers try and come back in, the sellers, create new lows. They create new lows, create new lows, create new lows. Market's trying to build a base here. But then look what happens right over here. Do you see all this price action right over here? Do you see how that all of a sudden looks very different? You all notice that? Why do you think that is? Why do you think all of a sudden the price action goes from healthy movements on both sides of the market to all of a sudden just any ideas? I talked about this in my monthly webinar that was free to everybody. Basing structure, very good. Buyers, just as buyers. Okay, what else? Consolidation, possibly consolidation, but usually consolidation will be more common after a break. You know, I'm more interested in consolidations after a break. This to me was a combination of sellers no longer feeling confident that they have control over the market. I mean, they were able to sell it off for 4 candles in a row, but why weren't they able to produce big candles? And Chris and Ganser. So Ganser says buyers absorbing selling pressure. That's absolutely correct. The volatility shifted. All of a sudden it shifted completely. I even wrote about this in my blog. So I wrote about this and I said, well, wait a minute. This is different. This is the price action changing a rhythm. It's changing a tune. So the sellers are no longer able to make the big strides that they did right over here. Now all of a sudden, even though they are pushing it down and have control for 4 candles, the sellers, the offers are getting absorbed. So that was the first sign, oh, wait a minute, this thing is really now finally starting to form a base. If it forms a lower low, that would be a really good sign of it. Then what happens down here? Pin bar rejection. I talked about this pin bar rejection and how I traded it. I talked about that, I think, last week. And so this right here was also a sign of accumulation. To me, it looked like a sign of accumulation. K. Lerner says, what time frame? This is the daily chart. So to me, this looked like a combination of offers getting absorbed and accumulation of buyers coming in. And that would make sense that we would get an accumulation of buyers coming in on a higher low. You wouldn't see accumulation on market making lower lows because that means the sellers are still in control. If they're still in control, they're going to try and drive the market a little bit further. But if they're failing to produce lower lows and they're actually producing higher lows, then they're going to start to phase out of the market because they realize they're getting absorbed. There's a stronger force on the other side of the market. They're getting absorbed, and that usually suggests accumulation. So then we know that there's a pattern relationship to the 20 EMA, which is either it rejects off of it or if it breaks above it, the first candle would close back below. Breaks above it, first candle closes back below. Breaks above it, first candle closes back below. So what would I be looking for? I would be looking for the market to develop a different relationship to the 20 EMA. That tells me that the rhythm of the price action has not only changed, but that the bulls are now unwinding the pattern of what has been dominating the market, and they're creating a new relationship to it. That tells me that's a further sign that the market is changing. Look what happens on the next candle. Instead of closing below it, instead of it being an opportunity for sellers to get in on the cheap and push it back down, they fail to make control of the market on the next day, and the market creates another new relationship. Instead of breaking down below it and treating this as resistance, it now treats it as support. So this is the first part of it here. Does everybody see that change in the price action, the relationship, and how it was a reflection of a different order flow? Yes, no? Okay, great. Quick question on it. Al says, looks like those 2 pin bars have formed a double bottom also. Yes, I talked about that. I think I actually talked about it in the last webinar. I talked about how it formed a double bottom and how I traded it. So, yes, absolutely. Okay, so the next one is, okay, so ramping it all up, we have a change in relationship to the 20 EMA. We break the pattern to the 20 EMA. We break the pattern of strong selling followed by strong buying, strong selling. The order flow changes because the price action, the nature of the price action, and the rhythm all changes. So higher low, smaller red candles, offers getting absorbed, accumulation starting to build like that. Now, Michael has the question, are accumulation candles less spiky like the last time you showed us? They can be. Usually they will tend to be more of this nature. But actually they tend to be more like this candle, suggesting there's still presence in the market on both sides. but they tend to have at least a decent sized body, and it's usually kind of a slow building up. Usually a double bottom, if it forms, like if this was the double bottom right here, and then it forms a higher low like this, that would show an accumulation of buying, basically. So the buyers are starting to take control over it. Not just the higher low, but the accumulation is starting to build. But then on top of it, we had other things here signaling that as well. We had two pin bar rejection, double pin bar rejection, both communicating to us that the buyers now were pushing back anytime it's sold off. They're saying, hey, we'll be happy to buy this on the cheap. We consider this a great opportunity to get long because we're going to take control of the market. So all these things together painted a new picture. Now, let's go to the 4-hour time frame, and I want to show you how I traded this. So it's actually right here. All right. Let me delete this line. Show you a couple things here. Do you see how there was a kind of support here? We have rejection, 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 rejection here. Rejection after an engulfing bar that failed to close at the highs. I mean, this is a very strong engulfing bar here. Makes the new low, immediately reverses gains, and as it tries to push up, the sellers come back in at this level and push it back down. So something told me that there's something about this level here. Now we can still see the bottoming formations happening. How can we see the bottoming formation happening and the offers getting absorbed? Every time it tries to push down, it gets pushed back with a very strong rejection. So we have reversal patterns all over the place. Pin bar, engulfing bar, pin bar, all telling us that the market had a greater propensity to reject downside prices than it did upside prices. If we were seeing the same size rejection and the same amount of rejections to the upside, then it would be a little bit different story. But all the reversal candles were to the downside. All the rejections were to the downside, telling us those buyers are now in place. And what happens over the last pin bar, we see the market starts to really build. This is the first time it's actually had a pretty good build above the 20 EMA. Most of the time it's been below the 20 EMA on the 4-hour. Now it's really starting to build. Look what happens. Big breakout bar. Big breakout bar. And then take a look at this here. And I want to zoom into this. So we know the level here, to me, is an interesting level. Now, we've seen that 1, 2, 3, 4, 5, 6 candles. So 4 out of 6 are bullish. Look at the 2 bear candles. This one means that there's very little sellers present in the market. This means that there was some sellers, but even though they pushed it down, the buyers said, hey, we're just going to keep driving this price up. So out of 6 candles in a row, 4 are bullish, and the 2 that are bearish do not suggest strong control on the bear side. So with that being said, okay, great. What happens after that? Do you see how the market produces 3 corrective candles back? Y'all see this here? Yes, no? Yes, no? Okay. Bulls have been in control for 24 out of 36 hours. They break a key level, which was holding the upside, and they do it with vigor. And how does the sellers respond? Do the sellers respond back with also vigor? No. 3 candles can barely retrace 50% of all the buying from this candle here. So who's in control? The buyers or the sellers? If the buyers in 1 candle can do twice the damage that the sellers can do in 3 candles, who's in control? Buyers are in control. So I'm watching this and I say, you know what? This is generally my time to get back in the market. Let's see how it responds to this level here. It produces a nice little doji right off of it saying, okay, the sellers no longer have any ability to really push this thing back down. The buyers bought it again on the cheap. So I said, okay, I'm taking a pullback here. And that's where I'm in. Now, what's the first thing we look at when we make a trade? I've been talking about this a while. Amateurs look for what, and professionals look for what? Exactly. The first things professionals are concerned with is risk. You can always tell if you've matured in the trading process, and I even wrote an article about it, is that if the first thing you're looking at besides the entry is profit, then you got your eye on the wrong target. You should be eyeing the risk right off the bat, and you should be gauging if this is valuable in terms of risk. Does the risk make sense or not? So with that being said, first question becomes, well, what should be my risk? Well, I definitely need to be below this low of the candle right here. I definitely need to be below this low here. Ideally, I'd like to be below the 20 EMA here. So what does that mean? That means that if I'm below the 20 EMA here, which is about $6 away, I need a minimum $12 target. So what would a $12 target of 54 mean? It would mean about 67. So there we go. Sorry, 66. Well, let's see how that plays out. So 66.05. Pain in the butt, but oh well, I'll get it. Does this make sense? Yeah, kind of. This seems to make a little more sense, and go figure that, this rejected here. But I can see how this makes sense. It's not my favorite target. I prefer a little bit better. But is it workable? It's workable. I think it's workable. Either it's going to hit this thing right here, and that will say that the buyers are exhausted at this point, or it's going to try and keep on pushing. I personally had thought originally that it might even make it up here, but it's a lot for gold to climb, after it had already been pushing and there's still so many sellers in the market. So very simple, 1666, prior swing point right over here, and then we can see how the trade worked out. It held, and remember, small candles on a pullback, if there is a trend or there's a group of players that are in control, small candles on a pullback are not threatening. They tell us that, especially if they're the opposite side of the market. So if the bulls are in control, the market pulls back to a support, or it pulls back to a 20 EMA, which is acted as support, as dynamic support or resistance, and then the market all of a sudden produces small candles going up to it, that's not a threat. What is a threat is when it's big candles going into it or big candles pushing back it, because that tells me there's strong participation. But if the pullback into support, or if the pullback into the dynamic support or resistance of the 20 EMA produces small candles, those are not a threat to me. It's the big candles that I should always be worried about. So when I see small candles on a pullback, I usually look at it as a confirmation that the buyers are still in control because they're the ones that are making the more dominant candle. Does that make sense? Yes, no? Okay. Hopefully answers, Jaguar, hopefully Harley answered your question about what kind of chart. Ganser says, did you enter with a limit or at the open? This is a great question. I did a buy on limit. I wanted to pull back to this level because the level to me was the reason why I wanted to get in. And the level should hold the support, so that's why I wanted to get back in. So hopefully that answers your question. KFX Learner says, are these small pullbacks ensued bars? I think you meant inside bars. Yes, they're all inside bars. And inside bars they tend to be a far better system traded as a with trend than a reversal. One second. Excuse me. Might sneeze again. Okay, maybe not. Sorry, I couldn't reach the mute button on my mic. I apologize. Thank you. So inside bars, I prefer to trade them as a with trend system. We actually talk about how to trade them in the course. We give statistics. We give very precise targets, entries, the whole thing. But just to give you a rough idea of how I trade it, I tend to relate to them as better with trend signals than they are reversal signals. Statistically, they play out much better that way. So hopefully answers your question. But yes, inside bars like these, if it takes 5 candles to not even equal the gains on one candle, the buyers are still in control. So to me, it's a no-brainer at this point. So trade worked out pretty nicely. Now, there was a second opportunity for me to get back into gold and see if you recognize the signal. Now remember, we kept seeing reversal signals to the downside, right? So all these bullish reversal signals. What was the majority of reversal signals we were seeing? Do you remember? Anybody remember? Can you hear me? BG, you probably just have to log back in. What were the signals? What were the reversal signals that we were seeing that was part of the bottoming formation? Who remembers what they were? Exactly. Rob got them. Pin bars. So we had 3 pin bars and we had 1 engulfing. So 3 pin bars and 1 engulfing. Adrian, there was actual no outside candle. It was 3 pin bars and 1 engulfing. So an outside candle is not, technically an outside candle can be an engulfing, but they tend to be defined differently. And engulfing has a much different definition than an outside bar. So hopefully answers your question. Well, guess what happened just after that? Another pin bar. So I've seen now 4 pin bars and 1 engulfing, continued confirmation. The market is happy to buy this on the cheap. Now, I saw this happening just the other day, and I said, wait a minute, whoa, this is an aggressive sell-off for gold. Keep in mind, look at where this thing opened. This thing opened at 62. It made it sub 1645. Actually an $18 sell-off in gold. So you would think if gold all of a sudden has an $18 sell-off, there's obviously a lot of sellers that are present in the market, or maybe there were some stale longs that wanted to dump some positions. But if the sellers were truly in the control, what should we see after a long sell-off like this? Keep in mind, I was watching this candle in real time just go. So I'm watching it, and then it just stops right at 1644. Actually, Michael, no, those long wicks must be really taking out long stops, must be accumulation. That's not what accumulation looks like. So I defined what accumulation looks like. That's not accumulation. Okay, great. So HL says yes, there should be follow-through. If the sellers are really in control, there should be follow-through. Why did the market go all the way down to 1644, drop $18, and then start to push back? As I was watching it pushed back to about 1650. And then I said, wait a minute, hold on. It started sticking at 1650. So I said, hold on, let's take a look at this. This is what it looked like on the 1 hour as I noticed it started to stick above 16p. It started to sit right there. Now take a look at this 1 hour candle. $18 was in 1 hour. 1 hour. So why wasn't there follow through? And why did the market drop from 62 to 44, $18, but then reject back 8 of the $18? Why? Why would it in 1 hour drop 18 and then lose 8 right off the bat? Any guesses? Stop hunting, somebody set up to correct price. Possibly there could have been some market. This was happening during the New York Open, which is often how the most price manipulations in gold tend to happen around the London and the New York Open. So they do tend to manipulate it there. That's true. One big seller, unlikely. I mean, there was a fair amount of institutionals that were already long. Nothing to do with the level. I look at it as more than likely the longs that I bought way back here were probably exiting some of their position. So we had some stale longs that are exiting some of their position. Keep in mind, a lot of these longs are long at 16.25. They just made $40 in gold. So with that being said, I look at that and say, okay, the bottom line is we had an $18 drop and $8 is rejected. What happens on the next candle? The next candle, doji candle. And I said, you know what? This level's holding. So to me, okay, this candle closes an hour later. This level's holding. I'm going to get into this here. So I literally got back in on a pullback. And then the first thing I said to myself was, hey, what's my risk? Well, the prior candle had rejected here, which happens to be the rejection at this point here from the London lows on 427 on Friday. then I need to put my stop beyond that. Do I want to put my stop way down here? That's a big stop. If I'm getting in at 52.92, 52.90, do I really want to have an $8 stop on gold? I'm not so sure about that. So I'd rather say, hey, let's just put it beyond that. What does that give me in terms of a stop? Gives me about a $3.50 stop. So what do I need to make on this? $7 minimum, which puts me right at about 1660. Now that doesn't seem to make sense to me, but this one does. So very simple trade. I actually left the target open because I felt like it might go a little bit past this. And then as soon as it started stalling, I just said I'll close it out at 64.5. So just under 65. I noticed that it started stalling, and I just said, okay, I'm done. It's not pushed through this right now, so I'm done. So I literally just closed it just under 65. So, but does everybody see why I made that trade? You know, the pin bar rejections had confirmed in the past the market was still interested in buying this on the cheap. They were interested in scooping it up on the downside. Does that make sense? Yes, no? Hopefully it does. Okay, great. So, with that being said, with the market being so choppy, I really only want to trade things that are moving and moving well. And right now, to me, gold and silver, oil's still a little choppy right now, but gold and silver and the yen pairs are really the pairs that are moving the best right now. I've really stayed away from euro and pound. You know, I like pound, but it's so far extended, I don't want to chase it. And so, with that being said, you know, I don't like Aussie, too choppy. I don't like Kiwi, too choppy. It's not going anywhere. Euro's too choppy. So I trade things that move, and I trade things that move well. So hopefully that makes a sense on this one here. Trader says, Chris, are your charts on US EST? No, they're actually, this is actually set to PST time, California time. And the reason why I do that is because the broker will, the charts will set the time based on the computer time. And the reason why I set it on PST time, because midnight PST is the London session open. So that's why I like it, because then I can set my pivot points, and my pivot points are to the London session open to London session open. But also the 4-hour candles are very nicely, they play out well inside the European session. You know, you can get an inside bar formation, and everybody seems to think, oh, I got an inside bar formation, or I got a, you know, an engulfing bar formation, so, you know, this thing's going to make money. Well, here's the funny thing about it. Did you ever bother to think that an inside bar formation, say on a 4-hour time frame, may not perform the same across all different server times? Remember, there are several server times out there. There's midnight, which some brokers consider, like MB Trading has midnight is a daily candle open, so their things are based on midnight 00. Then you have some brokers like FXCM UK which say GMT, but then you have some like FX Pro that say European open. So you can't treat all signals the same, because that will actually affect how it relates to the overall price action. We statistically tested it on multiple server times, and you can see a variance of 12 to 15% on that particular system based on the server time you're using. So there's a lot of people that say, oh, well, New York close is the best, but their 4-hour bars are on a really bad time frame. So, yeah, so not all server times are created equal. Some server times are better than the other. A couple quick questions. Okay, talk fast. Okay, so real quick, Rob has the question, what's your spread on gold? It's about 25 cents. So hopefully that answers your question. You got to remember, though, I get institutional pricing, though, so it's very different. I think the retail spread is about 30, 40, or 50 or something like that. I'm not sure. But, yeah, my spread is about 25 cents on that. Al says, sterling yen. Yes, you've been very patient. Al is Alistair in my class. He's actually one of my star students in my course. Very good at spotting reversals on an intraday basis. Al, I think I know what pattern you're trading. Do you have a question on this one, Al? Is there a question you have about it? Or did you just want me to see it? Did you just want me to confirm it's a pattern from the course? Al is very good at buying reversals, and so he bought the reversal on this, and I'll bet you I can guess exactly where Al got in, just under 129.50. So, all right. If there's anything you want me to say about this, Al, I will. But yeah. Boyke says, did you see my suggestion above? I haven't seen your suggestion. Can I suggest you finish your monthly webinar next week? Possibly. Yeah, maybe I can do it. All right, great. I should be wrapping it up right now. Boris is going to be coming in next. So if you can, please stay on for Boris. A good friend of mine, great guy. Him and I got to teach together at the last ITC. For those of you that are actually considering the ITC, I highly recommend it for a lot of reasons. I'll be sending out a couple notices on Facebook and my Twitter and everything like that, how you can get a discount on that as well. But I definitely recommend it if you have the opportunity, especially if you live in Europe. You have no excuse not to go. I flew from Argentina 16 hours to go to that thing. So if I was there, you guys should be there as well. All right, great. So that's pretty much it. I need to wrap it up. I want to thank you guys very much for coming. Please stay on for the next speaker. If you have any questions about what we do, feel free to check me out, secondskiesforex.com. I also recently just wrote an article called The 5 Mantras for a Developing Forex Trader. Feel free to check it out, share it, pass it on, comment, whatever you like, or spit on it, whatever you like to do. Doesn't matter. Some response is better than none. So I wish you all good luck trading. I'll see you guys next week at the usual time. Stay on for the next person. Until then, take care, everyone.